and thanks for joining this afternoon's Cuppa Club with Alain de Monteau, Operations Manager at ICOF Community Capital. My name is Jerome Heusinger. I'm a Senior Development Manager at Ethex, and we are supporting ICC's community share offer on our platform. Before we get started, there's some housekeeping to do. I would like to let you know that the Cuppa Club is recorded and made available to watch. And we also edit this to a highlighted version. Cuppa Club is not a financial promotion, and if you do need advice, please talk to an independent financial advisor. The Cuppa Club usually runs for 30 to 45 minutes, and it's an opportunity to meet and ask questions of Alain and hear about why ICC is such an impactful organization, how it aims to achieve its goals, what investments will fund, and the tax efficiencies offered. Please feel free to ask questions in the chat box, and we will take questions as we go along. Just before Alain introduces himself, a little bit about the share offer and what it's supporting. ICC are aiming to raise £500,000 through community shares to finance a revolving loan fund that empowers cooperatives and community businesses, helping to protect vital local assets. So that's my bit. Please introduce yourself and provide us with a very top-line explanation of what ICC does. And perhaps we could start with what ICOF means and what ICC means, just for absolute clarity.
Yeah, of course. Hello, everyone. My name is Alain, Alain de Monteau. I'm Operations and FCA Compliance Manager at ICOF Community Capital and ICOF Limited. So I've had two jobs since 1979, and both of them have been with cooperatives. So really, my experience is all within the co-op sector. Working at ICOF and ICOF Community Capital, I've been here as staff for 20 years, but I was a trustee for 5 years before that. And what ICC does and ICOF is support cooperative and community businesses through the provision of loan finance. Now, there is some confusion or just really just to explain, ICC is actually ICOF Community Capital, and that was set up in 1994 as a community benefit society in order to raise shares to then on lend as lending capital. Now, really, that was born out of ICOF, Industrial Common Ownership Finance Limited. So in 1973, a bunch of people got together in someone's lounge and recognized that cooperatives weren't really recognized by mainstream banks, and were having problems really raising capital in order to grow their businesses. So really, ICOF, Industrial Common Ownership Finance, begun in 1973, was the first CDFI in the UK. So those of you who don't know what a CDFI is, it's a community development finance institution, and they were set up really to address the need where to be a lender of last resort, if you like, where banks didn't understand, particularly co-ops, but also social enterprises and community businesses. So really from ICOF in 1973, it was felt that they were specifically for cooperatives and worker cooperatives. That was the market for ICOF Limited. But it was felt that we needed to expand our remit, if you like. So ICC was set up in 94, particularly looking at cooperative and community businesses. So there was more demand with companies setting up community benefit societies and raising funds that way. And so then we came along then to help them with loan finance.
Thanks. Could you give us a really good feel as to what kind of organizations you've supported in the past? Just a couple of examples and the impact, the local impact that your support has provided them with.
Yeah, of course. I mean, we're a victim of our own success, really, in terms of needing to have this share offer. The demand from community co-ops is high. We get referrals through the website. But in the past, really, we've supported nurseries, sort of organic food box schemes, community shops, community centres, social clubs, housing co-ops, community pubs. It's amazing how many of these, organisations have a community benefit society model, which has been around for over 100 years. If you look at your, miners' welfare clubs and things like that, they were set up at the turn of the century, in terms of, in order to support those communities where the workers were. But if we look at our current portfolio, 40% of it is in social and leisure, typically addressing issues such as access to services, isolation, loneliness, and particularly in rural areas. We work quite a lot with Plunkett Foundation. I'm sure people have come across them in the past. 20% of the current portfolio is in the housing sector. So that'll be predominantly housing cooperatives. 13% we can categorize as education, culture, and community, including our Women's Refuge and Community Centre. Both of those we put as case studies in the share offer document. We've also got 13% in community retail, so that's community shops. Many years ago, we had the community shops program, and we were involved in supporting over 100 shops, and that was a partnership between the Plunkett and the Esme Fairbairn Foundation. That was a great scheme where we provided the loan finance. The local community would form a cooperative and raise a third of the money through shares, and then a third of the money came as grant from Esme Fairbairn. So and really across that, really that's helped lever in. So I mean that's sort of 4.4 million over 32 years. And obviously, those businesses are raising shares. They're also getting grants. So that's combined with our loan finance has helped lever in over 3.2 million of extra finance into those organisations. So we're as big as the sum of our parts.
And it's obviously finance that is recycled, which further amplifies the impact and the benefit that you are aiming to achieve.
Yeah, absolutely. I mean, you're alluding to a revolving loan fund. I mean, it's just a really simple, it's a simple financial merry-go-round. I mean, if you look at 1984, our first share issue, we raised 300,000, £300,000. That's been lent and re-lent over 10 times. So that means, as I said before, we've invested 4.4 million. That's in over 100 different organisations. So we raise the money through shares. We lend the money. We look after. We look after the and support those organisations. They pay us back, and then we lend the money back again.
Yeah,
and I think that's underscored really by some of our of the percentages on loss rates over the years. We hang on to that money.
Okay, so let's get on to loss rates. But before that, look, as in much of social investment, there is a tension here between the maximization of impact and social benefit and at least capital preservation and perhaps a little bit of a return on top of that. Within your organization, how do you manage that? How do you assess potential clients or beneficiaries of your lending?
Yeah, fine. I mean, that's a great question. And so people will approach us. We will have referrals. We have a lot of repeat business from borrowers. We have borrowers that have been with us for 25 years. And they know that they can come and talk to us when they're developing their business or they're buying new assets. But also there's a network of community of cooperative development advisors. So we'll have people signposted towards us. They'll come through our website. They'll register their interest. That will then go to the lending and relationship manager. And the first thing we look at really is not whether the finances add up. It's what structure they are. Because we're specifically here to work with cooperatives, community benefit societies, employee buyout companies. That democracy, I think, is the strength really that makes our portfolio so strong, and is underlined in our kind of low loss rates. And then the loan officer will, if they've ticked that box that they're the right structure for us, then we'll ask them to fill in an application form, and then there will be a full due diligence appraisal. The loan officer will go and visit the business, talk to them. That will sort of generate a 20-page appraisal. Then that goes to the credit committee, which is 3 staff plus our treasurer, and then we will make that lending decision. So really, it's the lending officer who's making the proposal, and then it has oversight by 3 other staff and a director on the board to make that final decision. And we don't say yes to everything, but generally, so much work has been done beforehand that I would say 90% of the things that come across our desk we say yes to after the due diligence has been done, of course.
Yeah. Could you say a little bit about your recent credit loss trends? I mean, you have audited accounts for 24. I understand that you're about to release accounts for 25. What have been the recent trends? Question number 1.
Yeah.
And question number 2 is, to what extent is your loan book collateralized? I.e., if things do go wrong, is there an asset base that you can then rely on in order to secure loan repayment eventually?
Yeah, sure. I mean, we're very proud of our record. If you think that ICOF Limited, Industrial Common Ownership Finance, has been around since 73, and ICC has been around since 94, a lot of things have happened in the world and the world economy, and certainly two major things for us across all the organisations, with the banking crash in 2008 and COVID. So the loss rate since the inception of the fund and before the banking crash was 4.1%. So that's of the total capital, and the average over the 32-year life, so that does include the banking crash, is 5.82, which we think is much lower than you would see in the rest of the social investment marketplace. Now, the reason for that is because we communicate and we talk to our borrowers. What happened in COVID, we didn't lose a single loan through COVID. And if you think that there were a fair few community pubs in that portfolio, but what happened was we got on the phone and we rang all of our borrowers every single month before we were taking the collections and say, what do you need from us? And what they invariably were coming back with was, well, we've got great, the shop is shut, so we can't sell anything. But actually, those organisations, community pivoted, to be providing hot meals for old people and all those other things. So there were some cash flow, but invariably what people needed was capital holidays, just to take the pressure off their cash flows. And because we were communicating them, they might need that for 1 month, or they might have needed that for 6 months. But we were able to still collect interest from all those loans throughout that period, and we didn't lose a single loan because they knew they could talk to us. We weren't a big bank saying, right, you've broken your covenant. And I think we've discussed this before in terms of late payments and all the rest of it. We very rarely have late payments. People will ring us up and say, or ring up the loan officer, we've got a bit of a squeeze on, we've just bought this, can we have a capital holiday for 3 months? So people will contact us before it gets to that point where we have rejections. So, I could say across all the loan portfolios, we've last year probably had 5 missed payments, all of which were put in the bank at the same day, because either sometimes it's, the bank took it from the wrong account, these mistakes happen, but the loyalty and the customers, the borrowers have, means that they try and put that right as soon as possible. And certainly they're picking up the phone going, oh God, we're so sorry about this. We get this sometimes when we have bank reviews and, what's your, how many missed payments have you had? And people don't have, well, the CDO, Responsible Finance, who are the, obviously the membership organisation for CDFIs, they sort of, hang on, have you got this wrong? You haven't put anything in this number. And it's like, well, no, that's how it is, because we communicate with our borrowers and they communicate with us. So that's really what looks after the capital. So when we do have a loss, it hurts. We can only make that back through profits or through raising more share capital. But we're very proud of the loss rate in ICC over the last 32 years.
The question on collateral.
Oh, sure, yeah. Well, actually, what we do is if there's property or an asset, we will take a charge on that. So that will be a first charge on property, for example, or if somebody's buying a van or a truck or some machinery, then we would take a chattel mortgage on that. All loans have a floating debenture, so we're a preferential creditor in terms of administration events, which is very rare. And I did have a quick look at the current portfolio, and 80% of it is secured on property with a first charge.
That's
So pretty secure, but certainly everything would have a floating debenture. And of course, startups without property, we don't want to, we want to encourage, new businesses. So, there is some high risk, but we can de-risk by lending from different pots of money so that it's not all in one company. And that's the beauty of having ICOF Limited, the original company, and ICC. You put the money together, and you de-risk the lending.
so you distinguish really well between the approach, if you like, of mainstream finance and CDFIs, such as yourselves. Um, but then what you also emphasize is that there is no compromise in terms of loan losses. You maintain those at a very, very low level, and I think that's important to know. Alan, could you say a little bit about interest rates? So what interest rates are charged to your lenders?
Yeah, just on that last point, one other thing and a differentiation with mainstream banks is that we don't take personal guarantees. So we don't take people's houses, and that's what a normal bank would do if it got into trouble.
Yeah.
So that's I think that's pretty much across the CDFI sector. In terms of lending, we're not the cheapest. I guess the larger players in our market are people like Triodos, Charity Bank, Ecology, and they're a Unity Trust as well, and obviously they can probably offer better rates. But our standard rates are 3% over base with a minimum of 6 for secured standard secured loans. So that would be with a first charge on property generally, or a piece of kit, and then unsecured loans. We call them unsecured, so that's not with any property or any specific asset that we have a charge on, 4% over base and a minimum of 8. I'll just explain the minimums. We call them collars. Back in 2000, well, when bank base rate collapsed, we didn't have any minimums. So actually, I think a lot of people with mortgages, variable mortgages, were doing quite well then. But we then got into a situation where our average interest rate just went down and down and down. So we felt we need to put in minimums. So generally, we're offering a minimum of between 6 and 8%, and variable of 3 or 4, depending on the security. Obviously, that's beginning to fall now. So we have seen a peak in those variable rates, probably about 2 years ago. So as base rate comes down, then it's a better deal. And we do adjust that every month. So the loans paid to term, and clients are seeing their monthlies come down now as base rate comes down.
Okay. So let's look out to the future. So why are you doing this community share offer now? And most importantly, and I know you've shared this information with us during our due diligence process, what is your approximate deployment plan? Obviously, one can't be totally detailed because the money's not there yet, but were it to be there in a couple of months, roughly where and how would it be lent out?
Okay, obviously we haven't got, a queue of people, waiting for us to lend them money. Lending deals tend to have we're finding more and more, especially with the way the economy is. There's a long pipeline. the duration of the pipeline is getting longer. It's taking longer to put all the deal together. We're a victim of our own successes, as I said before, in terms of lending from ICC. So really, the purpose of the raise is to recapitalise our loan pot. So we're modelling on 500, max of 600. In the due diligence that we did, we modelled 10 loans of 50k on that. That could go up to 75k. 75k is our upper limit. So, that could be 10 loans of 50, or, a couple of 75s and some 50s and some 40s. It just depends what comes along. We are seeing that demand being driven through the transfer of community assets. So I think people will know about asset community value. People can register it. I think it's 6 months. How that is long enough for a community to get themselves together and form a CBS and then raise the money, I don't know, but they do it. They do seem to do it. And I think that there's a lot more sympathy within councils, particularly because councils want to sort of move their assets off their balance sheet and the corresponding liability of maintenance. So the kind of areas of community assets that we think we do see and we have in pipeline are sort of a range from art and heritage, community organisations, social clubs, food, farming, sports and leisure. You'll see Clapton Football Club, which is a case study in the share offer document. An amazing, amazing organisation that's got sort of female football teams, the youth football teams. It's working. It's dealing with that exclusion. They produced football shirts. They're an anti-fascist football team. They produced football shirts which actually one year sort of brought in more income than ticket sales, because they're being sold all over the world. So there's so many little stories like that. So there's a diverse pipeline, and particularly driven by asset transfer. I think people will know that Birmingham Council went bust, or did whatever their section, whatever. There was a lot of council assets were saved by them being transferred into community hands. That helped out the council, and that also gave communities the opportunity to maintain and control those assets.
So, just to recap, so up to now, Al, you've given us a fantastic account of your organization's pedigree, the history, the credit track record, if you like. You've given us numerous examples of social and community impacts that has been created by your organization, by your lending. A really important aspect of this issue are the tax efficiencies that come with it, and they are incremental to an interest rate that you are proposing. Before we get on to the tax efficiencies, because that's quite complex, could you just describe the outlook for interest payments over the next 5 or 6 years?
Yeah, do you mean talking about CITR as well in that
Let's
context?
talk about CITR after that, but let's start with interest, and then we'll talk about CITR.
Yeah, of course. Well, within I think the 7-year projections, I think in the share offer document, we're modelling 3% return. So that would be 3%. It's not paid out in cash. That would be added to your investments. That's kind of how we've done things with ICC since 94. But there is a range there. We're modelling 3 to 5%. But Ethex were very insistent that we fix with one number. And then anything on top of that would be a bonus in terms of financial performance. And things that would drive that would be higher lending than we projected. Interest rates. I mean, I think they're doing better on my projections now than they had, because they're stubbornly staying higher because of the oil crisis. Actually, in the projections, I have the bank base rate sort of tailing off. and obviously that's driving loan interest return and also bank interest return. So currently within the projections, we're already doing better than my projections. Sadly because of oil wars and things like that. So there is an opportunity there for people to grow their investment of between 3 and 5%, and 5% is achievable with the conditions that I've described.
Okay, so that's the sort of the base, 3 to 5%. I know Ethex were insistent, but we're just being conservative with the 3%. So let's talk about community interest tax relief, which is only achievable for organizations such as yourselves that work and support communities and cooperatives. Could you describe what that means for investors in a financial sense?
Yeah, sure. I mean, CITR has been around for quite a long time. I think probably about 15 years. We originally got CITR accreditation for ICOF Limited, but then we just had one investor, which was Cooperative Bank and then Ecology Bank. So we've used it in the past, and then we applied for accreditation for ICC probably about 18 months ago now, and we were pleased to achieve that accreditation. So what that does is it gives tax relief to investors of 5% a year over 5 years, so 25% tax relief over 5 years. And really that is to
5%, that's 5% a year over 5
yeah,
years.
yeah, 5% per annum, so 25% over 5 years. And the reason the government or the Treasury are doing that is to try and stimulate lending and make capital available for communities regeneration initiatives and businesses, mainly in economically disadvantaged areas and communities. So they're kind of trying to give tax breaks so that we can support those communities. So if you looked at a basic rate taxpayer, if you looked at the return including CITR, so let's go with the modeled 3%. You would look at a gross equivalent of 3%. The 5% for a basic tax rate, that basic rate taxpayer grossed up would be 6.25. So you'd be looking at a gross equivalent of 3 plus the CITR of 9.25%. I'm sure we can send this to people because it looks easier when it's written down. A higher rate taxpayer of 3% with a grossed up 5% at 8.33 gives you a gross equivalent of 11.33. And obviously that's where the CITR amount doesn't change. And the 3% could be 4, could be 5, could be 3.5. So the minimum you're looking at for a basic rate taxpayer, a return, including the CITR, including the interest we've modelled, is 9.25, and then a higher tax rate payer, you're looking at a gross equivalent of 11.33. So the CITR really sort of turbos the return, I think, on that.
So in an effort to simplify this, Ethex have put together a little video, which is on our website, which I would encourage people to watch. And we will be sending materials out subsequent to this call about this issue. This feeds into Will D's question. Hi, Ethex and ICOF. Could you please confirm that the intention is to return the capital and interest to investors as cash at the end of the 5 years, not as shares?
Yeah, absolutely. And if you look at the models that we've done, the financial models, we've modelled for a further share issue of 250k in 2029 and another 500,000 in 2031. So we are confident we'll be able to repay the 2026 CITR investors who may wish to withdraw. You may want to leave the money in. And a low take up of the two issues that we've talked about in 2029 and 2031, it would revert to a first come first served basis. But we're confident because we're doing we've modelled the two share issues in 29 and 31 that we'll be able to pay any investors that are investing in this year.
Thank you. And as I mentioned, that Ethex will be sending out more details and more clarifications about this issue subsequent to this call. So we're nearing the end. There's something that I read, Al, in one of your many documents that you submitted for due diligence. If you could just comment on this. So your organization, sound business finance coupled with equal opportunity, environmental concern, and the pursuit of social justice. Does that sum you up? Are those your hallmarks?
Yes, of course it is. But shouldn't that be the hallmark of all businesses? In this world that we're living, COVID has reinforced the importance of community support, cohesion, and self-help. We think community shares nurture a collective approach to all of those issues, really. And we always screen applications against our positive and negative criteria of our ethical policy. So really, we're doing it. Why doesn't everybody else do it like that? And we always see ICC as an ethical investment outlier. In 94, sorry, 94, you already had people like Equal Exchange and Cafe Direct come along. But people didn't really see us as an ethical investment. They saw us as a sort of cooperative lending to cooperatives. But I think that the language has changed. But yeah, it's disappointing that not all businesses really have the focus that we have.
Yeah, I was going to ask you for some final words for anyone thinking of investing, but I think you've summarized it really, really well. All that's left for me to say is that the community share offer is open until the end of May. We will be sending updates on the progress. So make sure that you're all signed up to get emails from us. And you can see how the offer is progressing on our website at ethex.org.uk. So, Alan, thanks so much for your time.
Thank you for the opportunity.
You've explained and described things really well. And thank you. And thanks everyone for tuning in.
Thanks for listening. Nice to meet you all.
Bye-bye.